Welcome back to the Wall Street Podcast. Today we're initiating a deep dive into the gaming industry, analyzing the key debates and estimates ahead of the Q2 2025 earnings season.
That's right. And our insights today are drawn from a pretty comprehensive report by Goldman Sachs. It's titled America's Technology, Internet Q2 of 25 Gaming Industry Preview, analyzing the industry debates and estimates ahead of earnings. And it just came out on July 22, 2025.
Okay, July 22nd.
Yeah. And this analysis, it really gives a detailed preview of the Q2 earnings, framing key company performances and the big industry themes.
So it's looking at things like IAP fees, user trends. I see Roblox and Playtika mentioned specifically.
Exactly. And also the AAA title pipeline, which is looking pretty robust, plus overall monetization and engagement metrics. It covered a lot of ground.
Got it. So let's start with those broad themes Goldman Sachs identified. What are the key takeaways there?
Well, they outlined four main ones. First, you've got this mixed consumer landscape. Game performance is still quite volatile.
Sort of a post-pandemic normalization effect?
Pretty much, yeah. Second, there's a really strong pipeline of AAA titles coming in the second half of 25 and into 2026.
Big names, I assume.
Oh, yeah. Think GTA VA, the next Battlefield, New Borderlands, stuff like that, which naturally heats up the competition.
Makes sense. What's the third theme?
Potential upside to current bookings estimates. This comes from tiered pricing on some of these big upcoming releases.
Tiered pricing, so like different editions, deluxe, standard, that kind of thing.
Exactly. Offering different versions at different price points, maybe with early access or extra content.
Okay. And the fourth?
It's just continued volatility, really, across new title launches.
Yeah.
But the established IPs, the big franchises, they're showing much more stability compared to brand new ideas.
Right. Less risk for the publishers sticking with what works.
Precisely. It de-risks their portfolios quite a bit.
So building on that, what are the specific investor debates Goldman Sachs highlights for the big gaming companies?
They get quite specific. For Electronic Arts or EA, it's all about Battlefield. When exactly will it launch? How much will it contribute to bookings?
And that tiered pricing aspect again.
Yes. How will that impact EA? Then for Take-Two, it's almost entirely focused on GTA6.
No surprise there.
Right. Timing is key, that the trailer, the actual launch date, plus pricing strategy and its long-term earnings power. Goldman's estimates are actually projecting over $3 billion in bookings for GTA6.
Wow, $3 billion.
Yeah, and they're looking at a non-GAAP PE around 28x in fiscal 27. So very high expectations baked in already.
Okay. What about Roblox?
For Roblox, investors are watching user trends very closely, especially, how durable are they after these viral experiences pop up.
And the near-term bookings potential.
That too. Plus, the company's bigger shift towards being more of a platform, really leaning into that user-generated content, or UGC, model.
And Playtika.
With Playtika, the focus is on their recent Disney Solitaire launch. Can it actually offset the declines they've been seeing in their older social casino games?
Interesting dynamic there. Let's talk about those in-app purchase, or IAP fees. That seems like a major discussion point.
It really is. There's this industry debate about the potential upside to gross margins if companies can shift more payments direct-to-consumer or DTC.
Bypassing the app stores, essentially.
Exactly. Avoiding those hefty fees from Apple and Google, which can be, up to 27% sometimes?
Yeah, or 15% for Google Play and the first million, then potentially higher. Significant chunks.
Definitely significant. So companies are testing these DTC channels, trying to figure out if it's truly accretive to gross profit and user lifetime value, LTV.
And the report suggests mobile users might find direct channels less of a hassle, maybe if there are perks.
That's the idea. Lower friction, especially if you get something extra for buying direct. But it's important to note.
There's always a but.
Well, yeah. Management teams, like back in the Q1 25 earnings calls, hinted that they might not just let all that fee relief drop to the bottom line to adjusted EBITDA.
They'd reinvest it instead.
Potentially, yeah. Into the product, into the platform, balancing that immediate profit boost with longer-term growth initiatives.
So it's not necessarily a pure margin gain?
Not guaranteed, no.
Yeah.
But the potential's there. Goldman gives some examples, like just a 10% shift of U.S. subscription sales from the App Store to DTC.
Okay.
Could mean a gross margin benefit of, say, 33 basis points for Roblox. That's 0.33 percentage points.
And for Playtika?
About 84 basis points for Playtika. And in dollar terms, that's roughly $20 million for Roblox and $25 million for Playtika, just from that 10% shift.
That's quite substantial, even with potential reinvestment. Okay, let's pivot to Roblox's user trends. You mentioned viral experiences.
Right. specifically Grow a Garden, which
Mm.
launched back on March 26th. It went viral and had a noticeable impact on their third-party user trend data.
So a big spike in users.
Definitely an acceleration. The long-term effects are still unfolding, obviously. But year-over-year monthly active user growth hit 33% by June 2025. Pretty impressive.
But is Roblox just reliant on these one-off hits?
Well, that's the key question, isn't it? But the data suggests maybe not entirely. Even with Grow a Garden being huge, historically, Roblox's top 10 experiences only account for about 30% of the total time spent in experiences.
So there's a long tail of other content keeping users engaged.
Exactly. It points to a broader, more diversified engagement base, which supports their strategy of being a platform, not just a single game publisher.
Okay, interesting. Now, Playtika and that Disney Solitaire launch on April 17th, that sounds like a strategic move, using well-known IP.
It is. It's a good example of extending key IP into new formats, working with Disney Games on this one.
And has it been successful in offsetting those declines in their older games, like Slotomania?
Apparently, yes. That new title, combined with some acquisitions they made from Superplay, seems to have done the trick. Looking at the data 90 days post-launch, Disney Solitaire actually outperformed some of their other titles like Dice Dreams and Domino Dreams.
Better monetization and user trends.
Correct, on both fronts. So it shows that diversifying with strong IP can really work, even in mature categories.
Let's look forward then. That AAA pipeline you mentioned earlier sounds like a big driver for the industry.
Absolutely. Key releases like the next Battlefield, Borderlands 4, and of course Grand Theft Auto the 6 are expected from, say, mid-2025 through fiscal 26 and 27.
That steady stream of blockbusters should definitely boost revenues.
That's the expectation. Although, interestingly, on the hardware side,
Yes.
the report notes that the PlayStation 5 has actually been lagging behind the PlayStation 4 in terms of cumulative units sold, comparing similar time frames up through 2024.
Huh. So maybe a slower console adoption cycle this time around.
It suggests that, yeah. Something to keep an eye on.
All right, let's broaden out again. What about the overall U.S. video game market? Monetization, engagement trends. What's the picture there?
It's pretty mixed, honestly. The overall market was basically flat in April and May. Content revenue was up slightly, about 2% year-over-year in May.
The hardware lagged.
Yeah, hardware down 13% year-over-year in May, and accessories down 7%. So year-to-date, total sales are actually still down 6% compared to the same period in 2024.
And who's performing well in terms of specific games and publishers?
Well, Take-Two continues to have a strong presence, mainly with their sports games like NBA 2K25 and PG Tour 2K25. And Civilizations VII stayed in the top 10 U.S. games year-to-date.
Okay.
Ubisoft's Assassin's Creed Shadows, which came out in March, held a top 3 spot year-to-date as well.
And EA.
EA saw better performance for EA Sports FC25 in May, and their game Split Fiction had a strong launch back in March, too.
What about digital platforms like Steam?
Steam looks very robust. It actually hit an all-time peak for concurrent users back in March 2025, 41.2 million. Shows the strength of PC gaming.
Wow, 41 million.
Yeah, but contrast that with Twitch.
The streaming platform, what's happening there?
Engagement actually declined. Viewership hours were down 4% overall in the quarter, and May saw the steepest drop, down 5% year-over-year.
Interesting. So maybe shifts in how people consume gaming content?
Could be. Or maybe platform-specific issues. Hard to say definitively from this data alone.
Okay, let's dive into mobile gaming specifically. What are the global trends there?
According to Sensor Tower data for Q2 25, we're seeing low single-digit percentage revenue growth globally. I think 1 to 3% range.
Yeah, modest growth.
Right. But that's coupled with declines in actual mobile game app downloads. Fewer people downloading new games.
So revenue per user must be increasing then.
Generally, yeah. But it really varies by genre. Overall, mobile monetization improved, but the casino category, for example, saw monetization decline in Q2, even though downloads were up slightly.
That's counterintuitive.
It is. Meanwhile, strategy games are gaining significant share revenue, up 24% year-over-year. RPGs, on the other hand, saw revenue decline.
Any other standout genres?
Yeah, interestingly, lifestyle, tabletop, and puzzle games all saw a decent revenue growth, like 12% to 13% year-over-year. And that was despite user downloads declining in those categories.
So they're really good at monetizing their existing user base.
Seems that way. Strong monetization per user is key there.
All right, let's maybe dig a bit deeper into some of these areas. Thinking about those IAP fees and the shift to DTC, you mentioned the potential margin upside, but also the reinvestment possibility. What are the sort of core challenges companies face in actually getting users to switch payment methods away from the app stores?
Well, the biggest hurdle is just ingrained user behaviors
Mhm.
and the sheer convenience of the app stores. People are used to having everything in one place, using payment methods already stored.
It's frictionless now.
Exactly. So overcoming that inertia, that friction, requires pretty significant incentives.
Yeah.
Exclusive content, maybe loyalty points, direct discounts, something compelling.
And it's not just user behavior, right? They're operational complexity too.
Oh, absolutely. Building and maintaining your own payment system, handling customer support directly, that's a whole different operation. So while the margin benefit looks good on paper,
Hmm.
the actual cost and effort to get users to switch means, yeah, a good chunk of that saving probably does get reinvested, like Goldman noted.
Yeah.
It's not just free money appearing on the EBITDA line immediately.
It's a strategic trade-off investors really need to watch.
For sure.
Okay, let's revisit Roblox and that Grow a Garden success. It boosted user growth, clearly, but given their long-term platform strategy focusing on UGC, how durable do you think that accelerated growth really is? What are the risks there?
Right, Grow a Garden gave them a nice bump, but the fact that they are relying on this broad UGC model actually helps mitigate the risk of being a one-hit wonder, you know?
Diversification is built in.
Sort of, yeah. The challenge, though, is keeping that creator ecosystem vibrant and productive. They need a constant stream of new, engaging experiences to keep users coming back and attract new ones.
So maintaining the pipeline of user-generated content is key.
Absolutely.
Yeah.
And the report suggests investors are focused on that the sustained growth of new experiences, the overall durability of user trends, not just these temporary spikes.
And the risks.
Well, you could see creator burnout, maybe competition from other platforms trying to lure those creators away, and just maintaining quality control and moderation across millions of user-generated experiences is a huge ongoing task.
Yeah, that sounds like a constant balancing act.
It is. Their success really hinges on keeping both the creators and the players happy and active.
Makes sense. Let's touch on Playtika again and mobile gaming diversification. Disney Solitaire worked well, offsetting declines elsewhere, but mobile downloads overall are dropping. What does this tell us about the long-term strategy for mobile publishers? Is it all about IP in specific genres now?
I think Playtika's move really highlights how crucial strong IP can be, especially licensed IP like Disney. It can genuinely drive growth and offset declines in older, maybe saturated segments like social casino.
It's a direct response to that tougher mobile market.
It looks that way. Low growth, declining downloads. That usually means user acquisition costs are going up. It gets really expensive to grow just by finding new players for old games.
So the focus has to shift.
Exactly. The implication seems to be a strategic need to diversify, either into genres that are showing revenue growth, even with fewer downloads like strategy, puzzle, those lifestyle games,
Hmm.
or by leveraging really compelling IP to get existing players more engaged and spending more. Basically, optimizing monetization per user becomes much more critical than just chasing downloads.
That sounds like a more sustainable path long-term.
Potentially, yes.
Hmm.
Moving beyond relying solely on traditional strongholds in what's clearly a very competitive and evolving mobile space.
So wrapping this up, this deep dive really paints a picture of a gaming industry in transition, doesn't it? It's dealing with post-pandemic normalization, but also has this potentially huge growth spurt coming from that AAA pipeline and these strategic shifts, particularly in mobile.
Yeah, that's a good summary. Companies are clearly focused on optimizing revenue, whether it's DTC payments, making the most of viral hits like Roblox did, or diversifying portfolios like Playtika. Capturing growth in these evolving segments is key.
It raises a final thought, though. With user acquisition getting tougher and more expensive, especially on mobile, how fundamentally will that reshape game development itself? Will we see an even greater focus on long-term engagement and monetization mechanics built in from day one, rather than just hoping a game finds a massive audience quickly?
That seems like a very likely outcome. Deeper engagement loops, more sophisticated monetization strategies, perhaps even more focus on live service elements to retain players longer. The economics are pushing development in that direction.
Something for investors and gamers alike to watch closely. Thank you for joining us on the Wall Street Podcast.